Hey everyone, and welcome to the third video on monetary policy. In this video, we're going to talk about the modern approach to managing the federal funds rate, and we're really going to split this up into open market operations and then discount policy. And within discount policy, we're going to talk about some what we call facilities or specific directives beyond the original Fed Act that the Fed created to help control for discount policy. So, if you remember our discussion on open market operations, after each FOMC meeting, the FOMC is going to decide what the Fed should target the federal funds rate to be and then give a broader economic assessment. After it does so, it needs to implement these open market operations. And so, what it does is it sends a policy directive to the Federal Reserve System's account manager, which is always going to be the vice president of the Federal Reserve Bank of New York. And then each morning, these open market operations are conducted on the open market trading desk at the Federal Reserve Bank of New York. So it's all concentrated in New York City. And then what they do is they're linked to the primary dealers through what's called the Trading Room Automated Processing System, or TRAPS. And the account managers, each morning, they're going to interpret the FOMC directive from the meeting. Uh, and then they're going to try and follow what the FOMC wants, and to make sure that the FOMC has clear day-to-day guidance on what should be done on the open market trading desk. The account manager is going to meet with two members of the FOMC every single day to discuss what's going on in the market and what directives should be and trades should be occurring on the open market trading desk. And open market operations are nice for a couple of reasons. First, they're extremely fast. It's an immediate trade. Also, they're extremely flexible because, uh, you know, they can pretty much trade whatever they need to on quantity, and so it's easier to change open market operations when there's, a sudden change in the market, because there doesn't really have to be a meeting. The FOMC just gives a directive and then the trading desk out implements it. Additionally, it gives the Fed a substantial amount of control because they get to initiate all the transactions. They don't have to leave it up to banks to enter into the contracts like with discount policy, and so they get to have a little bit more control of what's going on in the market and what goes on to the Federal Reserve's balance sheet. But now we're going to look at discount policy. And there's really three types of discount loans. There's primary credit, which are discount loans available just to healthy banks experiencing temporary liquidity problems. So these are solvent banks experiencing some sort of short-term shortage. And so these are usually extremely short, usually overnight, and they're requested from the standing lending facility. They also go, this generally is what is the role of lender of last resort is intended to do, is to be this primary credit source. Secondary credit are discount loans that are available to banks that are not eligible for primary credit. And these are usually not for healthy banks, because those healthy banks would go to primary credit. And so the secondary credits are monitored extremely carefully and have a lot higher interest rate than primary credit loans. Then seasonal credit are discount loans available to smaller banks in areas where agriculture or tourism are important. But with the development of a more broad national banking system, the seasonal credit facility is starting to diminish in its need, because there are alternative ways to help these cyclical banks. But in 2007, when there were so many problems in the shadow banking system, the Fed realized that where most of these problems were in institutions that could not access discount loans. And so the Fed, they have what's called the right to set up temporary lending facilities in quote unquote unusual and exigent circumstances. And obviously 2007 clearly acted as one of these examples. And so they created a couple more facilities that mostly shadowed the main discount policy facilities. First, they created the primary dealer credit facility. And these are primary dealers that borrowed overnight using their mortgage-backed securities as collateral, and it was the main way to allow primary dealers to access emergency loans. So uh, when we say primary dealer, these are temporarily liquidity or book problems. And so really these are the shadow banking analogy to primary credit. Then you have the term securities lending facility, which is where the Fed loaned up to $200 billion in treasury securities in exchange for MBSs. And the term securities lending facility had one objective and one objective only, which is to get these bad, corrupt, useless MBSs out of the market. And so it allowed these firms a way to borrow against illiquid assets because since nobody wanted the MBSs, they were essentially worthless to banks trying to become solvent again. And so by getting them off the books, it increased liquidity in the economy. The next was the commercial paper funding facility, which is where the Fed would purchase 3-month commercial paper issued by non-financial corporations. And by doing so, they stimulated activity in the commercial paper markets so that money market mutual funds could meet their short-term needs for commercial paper. Because if you remember, these money market mutual funds, as the financial crisis worsened, were also at extreme risk because just nobody was issuing and buying commercial paper. And then finally was the term asset-backed securities loan facility, or TALF. And in TALF, the Fed extended 3 or 5 year loans to help investors fund the purchase of asset-backed securities. So asset-backed securities are structured a lot like MBSs, except they're for other types of assets like loans or auto loans or something like that. So the ABS market also dried up. Shock, surprise, surprise. And so by creating the TAL facility, this allowed firms to borrow against other forms of the liquid assets besides the MBSs. And it was important to distinguish between the MBSs and ABSs because the idea with the ABS separation is that ABSs aren't quite as risky to own on the books, and so the interest rates that TOLF paid were quite a bit lower, or that TOLF required. And then all of these facilities did close by mid 2010. And in this graph below, you can see just how big these lending facilities grew in the Fed when you compare to just the classical discount loans facilities. So the first three that we talked about, the last four of these major facilities just got massive, massive, massive. These are in billions of dollars. So we're talking about $1 trillion was loaned out in these four lending facilities in 2009. And then everything closed down in 2010. Everything, a lot of it got paid off. But then COVID came around and put the Fed under even more pressure. And so the Fed had to revive some of the old facilities and create new ones. So the facilities that it revived were the primary dealer credit facility, the commercial paper funding facility, and TOLF. And within TOLF, they actually did accept MBSs. And this one. And then they also created a few more facilities. They created the Money Market Mutual Fund Credit Facility, where the Fed made loans to banks and other depository institutions, with banks using assets purchased from money market mutual funds as collaterals. And so this is the important part: is the assets that they purchased stimulated activity with money market mutual funds. And this is important because the money market mutual funds were a major focus point since they were at extreme risk of collapsing, since they were the biggest buyers of commercial paper and nobody was issuing commercial paper. So the idea was to get some sort of commercial paper activity in a time where businesses aren't taking out loans. Next were central bank liquidity swap lines, and this was more international focused. This was global centric, where the Fed expanded foreign central banks' access to US dollars because there was a lot of appeal for by foreign businesses for US dollars because they feared the collapse of their domestic currency. So they wanted to essentially hide themselves away in the dollar. Additionally, another global centric one was the Facility for Foreign and International Monetary Authorities. And what this did was allowed temporary exchanges of U.S. treasuries for U.S. dollars to be made in foreign countries. And so this meant that foreign central banks could access U.S. dollars without selling U.S. treasuries. And so the problem with what was going on is, as I mentioned, everybody was hiding away in the U.S. dollar. And when all these foreign central banks, which held on to U.S. treasuries to help stabilize their books, when they're trying to sell them off, that posed a huge risk to the U.S. T-bill market. And so, by allowing them to go straight to US dollars while keeping their treasuries on the books, uh, it it reduced the number of participants in the T-bill market and increased the control the Fed had over it. And that was really what this was about. It wasn't about trying to help these other governments out. It was about giving the Fed the control they wanted and needed over the T-bill uh, market. Then they also made the primary market corporate credit facility, which were loans to corporations by purchasing exclusively investment grade bonds that were newly issued. So these were just direct loans to uh, investment grade companies. Then in the secondary market for secondary market corporate credit facility, they bought investment and later on non-investment grade bonds in the secondary market. And then the CARES Act really was important with the secondary market corporate credit facility because it allowed the Fed to underwrite up to $75 billion in losses on these corporate bond purchases. And so the Fed was able to be a little bit more liberal with who it was investing in. And then that is what allowed them to get into these non-investment grade, uh, these junk bonds to try and prop up the bond market and get bad bonds off the books of investment banks. Then you also had the municipal liquidity facility, which were short-term bond purchases from state and local governments that was funded by CARES Act. And then there was the Main Street New Loan and Expanded Loan Facility, so the MSNLF and the MSELF. And these were intended to be 4-year loans to companies up to 10,000 workers or with revenues of less than $2.5 billion because the CARES Act put pretty strict caps on which companies could access CARES Act funds. And the Fed was worried about companies that weren't, these large, massive companies that could receive direct Fed aid, but uh, still needed that federal assistance. So the problem with the Main Street Lending Facility is that it was intended to work as a supplement to PPP, but it actually wasn't very effective because there were a lot of administrative problems, and so it really wasn't used all that much.